video. So for this one, we're going to be talking about the much anticipated sponsored candles. Now, essentially, by definition, and I'm just going to write this down because you guys should make a note of this, what a sponsored candle actually is a footprint left by institutions signifying a region where they are happy to enter / offload positions. Just give me 1 second. I'm slightly ill, so if my voice is a bit off, you know why. So essentially, what the sponsored candles actually are is obviously a footprint left behind by the institutions. Now, what it actually is high net worth market participants, which are obviously these institutions, banks, or whatever it may be, and it's high net worth market participants showing. Let me just close my Discord. Showing interest, which is illustrated through large. My phone's bugging. High volume candles. So make a note of this. These are like important notes to consider. Now, I'm just gonna roughly walk you through. It's gonna illustrate what SCs actually are. So, let's say we got candle, another candle here, and let's just have another one here, right? And we got obviously wick. Let's stay in drawing mode. Another wick here, wick here, wick here, here, and finally here. Okay, so we obviously got these wicks, and what we actually got is a inefficiency within here. Let's make this grey to make it a bit less confusing. Now, what you usually tend to see is price will come back up into this region, and should institutional or high net worth market participants choose to enter, what you actually see is a strong push up, right? Followed by a nice reaction, which is usually illustrated through 3 strong pushes to the downside. So let me just make these red. Bang. And finally here, red. And for the sake of argument, we'll make this blue. Let's get blue in here. Okay, cool. Now, what you actually, so this candle here would be our sponsored candle. Why? Because this is the candle that actually mitigated the inefficiency. And if you go back to the mitigation video, what I actually said is that they buy to sell. So once they've bought, their buy positions are still open, and they're actually in drawdown whilst this move is like taking place. So whilst price goes into profit, their buy positions are still open. So what they do is they eventually come back to either the open of the SC, which is right here, or the 50% of the SC, which is right here, and then that's where you take your position, right? And when you're looking at the actual SC, what you want to kind of identify is a large body to wick ratio, meaning more body and less wick. And obviously, shout out to Alex and Matt who are in our chat. They're actually the ones who taught me this. So, and what you also actually want to look for is a strong reaction post SC. Now, why the strong reaction is important is this. If you go back to obviously the very first video, retail versus institutions, I told you guys that retail traders don't have the financial capacity to pull off moves like this, right? So if high net worth market participants were to enter, it won't be shown through choppy, slow, sloppy price action like this. This here doesn't illustrate millions of lots. This here does. If they were to enter with millions of lots, it won't be shown through choppy price action like that. It will literally flush, and that's how you kind of identify them. What else have I? Let me see if I've missed anything out. You want a strong reaction, and so if you often, so let me just delete all of this. So you can get an SC that's within the range like this. So this is obviously the range. We came up, we formed an SC, then we came back to it. So this is an SC that you can find within the range. Now you can also find an SC that is, they're usually at the top of a range. And by that I mean sometimes you got, for example, a double top form, and then price will come down, come up, take out that liquidity, and then what you get is an SC, and obviously price will obviously come back down, come to the 50% of that SC, and then that's how you take the move to the downside. And it's so if it's like this, it's usually the last bullish candle before the bearish impulse, and if it's the other way around, it's the last bearish candle before the bullish impulse. I'm just gonna show you a few examples. Let's see if I missed out anything. Yeah, also you preferably kind of want the sponsored candle to take out some form of liquidity. It's just kind of like another cherry on top for the setup. So I'm going to show you an example where we actually got that. So if you look here, we obviously had price consolidating for a little bit, and if you look to the left here, what we actually had was a inefficiency fill. Now going back to the following prices narrative video, what I explained is that if we got an inefficiency fill and we have a reaction, 9 times out of 10 we're going to come back to that general area because we're following prices narrative, right? It's a mitigation, another mitigation, and then we'll probably come back and mitigate out of this. So let me just chart this up with you guys, yeah? So here we had a inefficiency fill, right? The SC that we had took out obviously these highs here. They're not equal highs because the one on the right is actually higher than the one on the left, but this candle here obviously burst up and took out all the liquidity resting within this region here. So we got liquidity purge here, lick purge. What else have we got? Oh, yep, obviously our strong downside reaction. Now usually you either want 2 strong large bearish candles or 3 consecutive bearish candles without indecision. So you want bearish candle, bearish candle, bearish candle, and no dojis, no indecisions, right? So here we obviously had a strong 1 candle reaction all the way down to the downside, which is also valid. So what our SC actually is this last upside push before that large downside impulse. That's our strong preferred reaction. So all these points are what we basically, so all these points are basically what we kind of call confluences, right? All these little kind of things I've marked out is our confluence. The inefficiency fill is our confluence. Liquidity purge is a confluence. The strong desired reaction is a confluence. These are all kind of like tick boxes that need to be met for the SC to be valid, right? Now, so what you basically now look for is either the open, which is the very bottom, or the 50%, which is here. If the candle, now this is my personal rule, if the candle is anywhere between, 5 pips, I'd look to take the open because I don't mind having a 5 pip stop loss, but if it's larger than that, I don't mind having I don't mind taking it from the 50%. And obviously you guys know we take it from the 50% because that's where the average volume is. So if you look at this example, we obviously came up. Now you would obviously look to take the position from, I'd prefer to take it from the open in this case. Have my stop, you can have it right above the candle, so that's a 11 pip stop loss, which isn't obviously the best, but riding it all the way down here, nice 6%. Let's pay this out. There you go, perfect tap, and price fell straight to the downside. Took out this level of this external range liquidity here, and we managed to catch 6-7%. Obviously, if you do the 10 pip rule, you would have caught around maybe 8-9%. That would have been nice. So obviously here you had your strong preferred downside reaction right there. Got the SC here, which was also valid on the 8 minutes. So if I go to the 8 minute, you can see that that sponsored candle is still there and it's still valid. That's pretty much it for like sponsored candles. Let me just show you another example. Let's go to Euro GBP. Okay, cool, perfect. Okay, right. Let me actually delete a lot of this noise here. It's unnecessary. Actually, let's delete all of this. Let's delete this. Remove. Yes. Remove. Yes. Okay. So, if you guys watched the Zoom, you obviously saw that we had a 40-minute inefficiency fill right here. And again, we had a mitigation following price's action. Price actually left a beautiful, I think it was a 10-minute SC. Yep, right here. So notice how, let me actually scroll here. Notice how this candle here, the last upside candle before the downside push was pure body, and we had in this case we had 4 consecutive pushes to the downside, and we actually continued on to the downside up to here. So this showed us that large, obviously, investors, institutions, they were happy to offload their positions here. And what you do, obviously, we had obviously a break of, maybe if you go to the lower time frames, which I'm not going to do because that's not the purpose of this video, but we obviously had breaks of structures along this price leg here. So what you do is you mark out the candle. So this was obviously our sponsored candle. Mark out the 50%, and then you short it from here. Now, notice how this is what follows price's narrative, because that's the candle that mitigated the SC. So when you have an inefficiency within here, that doesn't follow price's narrative. Yeah, it is an inefficiency. There is logic behind it. It needs to be filled, but the candle, the SC in this scenario, the SC is what follows price's narrative. Obviously, would have taken the trade here, 3.3 pip stop, and should you have taken full profit at this low here, you have captured 19%. Literally perfect illustration of how you can use that. And obviously the example before on Euro USD was how you can get the SC within the range, and obviously in this case it was at the top of the range, the last bullish candle before the bearish impulse. And if you're looking at sells, it's the same thing. So it'd be the last bearish candle to the downside before the bullish push. Multiple breaks of structure, came down, and then again break of structure here. You would have broke even / risk freed your position, and yeah, that would have been it. That's basically sponsored candles. There's nothing much really to it. The only thing is, make sure that your reaction is strong. If the reaction is weak, invalidate. It's not gonna work. The reaction has to be strong, because the reaction is what indicates to you that they've entered with like high pressure. High net worth market participants don't it's not illustrated through like weak, choppy price action like this. It's illustrated through strong pushes like this, right? But yeah, that's pretty much it for sponsored candles. So just keep in mind, you want to have a strong reaction. It must have a large body wick ratio, and it's even more valid if it took out some form of liquidity. So obviously this candle here took out the lows below this candle here. So if we just replay and come about here, go to the 1 minute, okay, you see that we had basically equal lows right here, right? We had liquidity resting below here, and price literally purged and then bounced back up, took off, right? So if you have it's more valid if it took out liquidity, and preferably you'd want it to mitigate something. So for example, in this case, let me just invert, go back to the 10 minute and get out of replay. So preferably you'd want it to either mitigate something, which is what it did here, or you'd want it to take out liquidity, because often what institutions do is they purge liquidity and then they enter. So they buy, and within that buy they would have taken out the double tops, for example. So let me just illustrate that. So let's just say, for example, we had a double top right here, and then price did this. It would have came up, purged that liquidity, came back down, and then obviously we would have came back up to that level, and then again back down. So yeah, so you'd either want it to preferably mitigate something or purge liquidity, and it needs to follow price's narrative, right? You see here, this followed price's narrative. We had an inefficiency, we purged liquidity within here, we moved strongly to the downside, and then we came back up, and this follows price's narrative. We didn't take a random inefficiency within here. We followed price's narrative. We came back up to that region, and we followed price basically. But yeah, I hope that makes sense. If you guys got any questions, obviously feel free to ask me. It's a fairly simple concept. There's nothing really much to it. Don't overcomplicate it. It is it is very easy to kind of identify. And yeah, besides that, thank you guys for listening, and on to the next.